Hi there, it's Friday the 1st of March 2019. I'm Steve Towers. Welcome to ITB. Let's get started. There's only been a few developments this week in regard to digital taxation. I'll quickly run through them. The prospects for an EU digital advertising tax to be agreed at the next ECOFIN meeting on the 12th of March appear to be low. The Irish government has publicly indicated its continued opposition, and it's been suggested that the watering down of the tax from digital services tax to digital advertising tax has ironically reduced its likelihood of finding support. With a narrower tax base, a number of member states are now questioning whether a DAT would provide sufficient tax revenue to make the effort worthwhile. It looks like the official US policy is to support both the marketing intangibles proposal in Pillar 1 and the global anti-base erosion proposal in Pillar 2. US Treasury Secretary Steven Mnuchin indicated support for the French-German global anti-base erosion proposal with its global minimum tax when he met with his French counterpart in Paris this week. But some US commentators have said this week that the global minimum tax could be very difficult to draft. For example, will it apply on a per-country basis or global basis? As you know, GILTI, which apparently is the inspiration for the global minimum tax, applies on a global basis. But the OECD's consultation document indicates a per-country basis. Will there be expense allocation rules? And will foreign tax credits apply? Such complexities might suggest that the ordering rule would be to favour the market jurisdiction. And in regard to India, there are still no details on the thresholds for the significant economic presence rule, which will commence operation on the 1st of April. It's been suggested that the release of the details will be delayed due to the upcoming general election, which is scheduled for May or June. But please remember, the significant economic presence rule will be applicable only for domestic tax purposes. Technically, it has no impact on India's treaties. Well, the current truce in the China-US trade war has been extended. You'll remember that the US initially imposed additional customs duties at 10% in September 2018. Those additional duties are still in effect. Under the original timetable, that rate was set to increase to 25% on the 1st of January 2019. However, as part of the truce, the increase to 25% was delayed until tomorrow, the 2nd of March. Well, the US government has announced this week that the increase to 25% will be further delayed indefinitely. For a copy of an email alert from the US customs authorities, please go to our website. In Hong Kong, the government has presented its 2019 budget. Only a few items caught my eye. There will be a small reduction in the profits tax liability for 2018-19, capped at 20,000 Hong Kong dollars, which is about 2,600 US dollars. Tax incentives will be introduced in the maritime sector, including for marine insurance. and the government will consider the introduction of a limited partnership regime for private equity funds and a more competitive tax arrangement to attract private equity funds to set up and operate in Hong Kong. In India, the Mumbai Income Tax Appellate Tribunal has decided a case called Bureau Happold. It concerns the Fees for Technical Services article in the India-UK Treaty. As you know, in many of India's treaties, the definition of fees for technical services includes a so-called make available condition, which reduces the scope of the definition. The India-UK Treaty is one of those treaties. Here's the relevant part of the definition. The term fees for technical services means payments of any kind to any person in consideration for the rendering of any technical or consultancy services, which c. make available technical knowledge, experience, skill, know-how or processes, or consist of the development and transfer of a technical plan or technical design. In this case, a UK company rendered technical or consultancy services which consisted of the development and transfer of a technical plan or technical design, which is referred to in the second limb of paragraph C. The issue in the case was whether that was sufficient to satisfy the definition, or whether the make available condition in the first limb of paragraph C, make available technical knowledge, experience, skill, know-how or processes, also had to be met in order to satisfy the definition. Interestingly, the tribunal held that the make available condition had to be met. It said this: on a careful reading of Article 13.4c of the India-UK Treaty, it becomes clear that the words or consists of the development and transfer of a technical plan or technical design appearing in the second limb has to be read in conjunction with make available technical knowledge, experience, skill, know-how or processes. The reasoning of the assessing officer that the second limb has to be read independently, in our view, cannot be the correct interpretation of the said article. As per the rule of iusdem generis, the words or consists of the development and transfer of a technical plan or technical design will take colour from make available technical knowledge, experience, skill, know-how or processes. In other words, it is necessary to examine whether by supply of technical designs, drawing and plans, the assessee has made available technical knowledge, experience, skill, know-how or processes. For a copy of this case, please go to our website. Also in India, the government has released a draft national e-commerce policy. There are only 2 paragraphs expressly on taxation. Here's the first paragraph, which discusses the significant economic presence proposal. Please hit the pause button to study this. And here's the second paragraph, which discusses the imposition of customs duties on electronic transmissions. Again, please hit the pause button if you would like to study this paragraph. For a copy of India's draft policy document and for a copy of the 2017 UNCTAD report, please go to our website. And finally, in India, the GST Council has recommended GST rate reductions for residential property. The proposed new effective rates will be 5% without an input tax credit on residential properties outside the affordable sector and 1%, again without an input tax credit, on affordable housing properties. The definition of affordable is based on geography and property size. For a copy of the government's press release on this matter, please go to our website. Korea has become the latest country to release guidance on its MAP procedures. For a copy of Korea's guidance, please go to our website. In New Zealand, a government-appointed panel, the Tax Working Group, has issued a long report with a myriad of recommended law changes. The government intends to provide its response to the report in April. There's only a few items in the report which should be of interest to multinationals. There's the digital services tax, which I mentioned in last week's ITB. There's a recommendation that a comprehensive capital gains tax be introduced. And then there are some items which the report recommends not be changed. No change in the corporate income tax rate, which is currently 28%. No change in the dividend imputation system, and no changes to the GST rate or exemptions. For a copy of the report, please go to our website. In Singapore, the tax authorities have issued updated guidance on the tax treatment of public-private partnership arrangements. For a copy of the updated guidance, please go to our website. The European Court of Justice has delivered two landmark decisions concerning the Parent Subsidiary Directive and the Interest and Royalties Directive. The two decisions were delivered by the same judges, 13 in all, comprising a grand chamber. The two decisions both involved joined cases, all from Denmark. The Parent Subsidiary Directive decision involves two joint cases, and the Interest and Royalties Directive decision involves 4 joint cases. And the two decisions are very similar. I'll look at the decision on the Parent Subsidiary Directive first. A simplified structure for the first joint case on the Parent Subsidiary Directive is shown on the left. A Danish company planned to pay a dividend to a Luxembourg parent company, Luxco II. It sought a ruling from the Danish tax authorities. For the purposes of the ruling application, the Danish company assumed that Luxco II would then pay its own dividends to its Luxembourg parent company, Luxco I, and that Luxco I would then pay the cash as dividends and or interest and or debt repayment to companies controlled by private equity funds established in third countries. A simplified structure for the second joint case is shown on the right. Another Danish company paid a dividend to its Cyprus parent company. The Cyprus company used the cash to pay interest and to repay debt to its parent company in Bermuda, and the Bermudan company used the cash to pay its own dividend to its US parent company. The issue in both of these cases is whether the dividends paid by the two Danish companies to parent companies established in other EU member states, Luxembourg in the first case and Cyprus in the second, qualify for exemption from Danish dividend withholding tax under the Parent Subsidiary Directive. At the outset, it's important to note that the facts in both cases occurred before 2012. This means that the version of the Parent Subsidiary Directive which is relevant is the 1990 version as amended in 2003. And critically, that means that the anti-abuse rule, which was added in the directive in 2015, is irrelevant to these two cases. Instead, at the relevant times, the directive said only this in regard to abuse. This directive shall not preclude the application of domestic or agreement-based provisions required for the prevention of tax evasion, tax fraud, or abuse. In other words, Denmark is entitled to apply domestic law provisions or agreement-based provisions to prevent tax evasion, tax fraud, or abuse in regard to the directive. However, at that time, Denmark did not have any relevant domestic anti-abuse provisions. Although it did have some anti-abuse doctrines, the parties and the court accepted that they were not triggered in either of the cases. And so the Danish tax authorities argued that EU law contains an unwritten anti-abuse rule, which applies to the parent subsidiary directive, and the court agreed. It said this: thus, in the light of the general principle of EU law that abusive practices are prohibited, and of the need to ensure observance of that principle when EU law is implemented, the absence of domestic or agreement-based anti-abuse provisions does not affect the national authorities' obligation to refuse to grant entitlement to rights provided for by the PSD where they are invoked for fraudulent or abusive ends. The court described the anti-abuse rule in this way. Proof of an abusive practice requires, first, a combination of objective circumstances in which, despite formal observance of the conditions laid down by the EU rules, the purpose of those rules has not been achieved. And second, a subjective element consisting of the intention to obtain an advantage from the EU rules by artificially creating the conditions laid down for obtaining it. Examination of a set of facts is therefore needed to establish whether the constituent elements of an abusive practice are present, and in particular, whether economic operators have carried out purely formal or artificial transactions devoid of any economic or commercial justification, with the essential aim of benefiting from an improper advantage. The court stated a number of related factors which are indicia of an abusive practice. A group of companies is not set up for reasons that reflect economic reality. A dividend is passed on very soon after it is received to entities which don't qualify under the parent subsidiary directive. A dividend is received by a conduit company, a company where its sole activity is the receipt of dividends and their transmission to the beneficial owner or to other conduit companies. And various contracts existing between the companies involved in the financial transactions at issue, giving rise to intragroup flows of funds by the way in which the transactions are financed, by the valuation of the intermediary company's equity, and by the conduit company's inability to have economic use of the dividends received. In this connection, such indications are capable of being constituted not only by a contractual or legal obligation of the parent company receiving the dividends to pass them on to a third party, but also by the fact that, in substance, as the referring court states, that company, without being bound by such a contractual or legal obligation, does not have the right to use and enjoy those dividends. As you can see, the court's decision was significantly influenced by the OECD commentary on the beneficial owner condition in Article 10 of the OECD Model Treaty. Let's now look at the 4 joined cases on the Interest and Royalties Directive. A simplified structure for the first case is shown on the left. Denmark Co paid interest to Luxco 2, which paid interest to Luxco 1, and which in turn paid interest to a number of private equity funds established in third countries. A simplified structure for the second case is shown on the right. Denmark Co paid interest to Sweden Co 2, which made a group contribution under Sweden's tax loss transfer system to Sweden Co 1, which in turn paid interest to Luxco, which the Danish tax authorities viewed as a transparent entity for Danish tax purposes. Luxco was owned by a number of private equity funds established in third countries. A simplified structure for the third case is shown on the left. Denmark Co paid interest to Sweden Co 2, which made a group contribution to Sweden Co 1, which in turn paid interest to Cayman Islands Co. And a simplified structure for the fourth case is shown on the right. Denmark Co paid interest to Luxco, which in turn paid interest to a number of private equity funds established in third countries. The issue in all 4 of these cases is whether the interest paid by the Danish companies to the lenders established in other EU member states, Luxembourg in 2 of the cases and Sweden in the other 2 cases, qualifies for exemption from Danish interest withholding tax under the Interest and Royalties Directive. Let me quickly run through the key provisions which are relevant in these cases. Firstly, Article 1.1 says this: interest payments arising in a member state shall be exempt from any taxes imposed on those payments in that state, provided that the beneficial owner of the interest is a company of another member state. Secondly, Article 1.4 defines beneficial owner. A company of a member state shall be treated as the beneficial owner of interest only if it receives those payments for its own benefit, and not as an intermediary, such as an agent, trustee, or authorised signatory for some other person. Let me pause there to make a few comments. The use of the beneficial owner concept has obviously been borrowed from the OECD Model Treaty. Also, you can see the influence of the OECD commentary on Article 1.4, its own benefit and not as an intermediary. But see the phrase such as an agent, trustee, or authorised signatory. There's no reference to a conduit company, which might be explained by the fact that the Interest and Royalties Directive and the amendments to the OECD commentary in regard to conduit companies were both finalised at about the same time. And the third relevant provision is Article 5, which deals with fraud and abuse. 1. This directive shall not preclude the application of domestic or agreement-based provisions required for the prevention of fraud or abuse. 2. Member states may, in the case of transactions for which the principal motive or one of the principal motives is tax evasion, tax avoidance, or abuse, withdraw the benefits of this directive or refuse to apply this directive. Let me pause here as well. Article 5.1 is in effectively the same form as Article 1.2 of the Parent Subsidiary Directive. And as we've already seen, During the relevant years, Denmark did not have a relevant anti-abuse provision in its legislation. But when you look at Article 5.2, you might think that this provision can be directly applied by the Danish tax authorities. But apparently that's not right. The courts seem to indicate that the Danish tax authorities would be able to apply Article 5.2 only if it had been transposed into Danish law, which it had not. Well, the first issue addressed by the court was the meaning of the term beneficial owner. The court made a number of comments. Firstly, the term beneficial owner concerns not a formally identified recipient, but rather the entity which benefits economically from the interest received, and accordingly has the power freely to determine the use to which it is put. Secondly, the OECD commentary on Article 11 is relevant in determining the meaning of the term beneficial owner. And thirdly, in regard to conduit companies, it is clear from the development of the OECD Model Tax Convention and the commentaries relating thereto that the concept of beneficial owner excludes conduit companies and must be understood not in a narrow technical sense, but as having a meaning that enables double taxation to be avoided and tax evasion and avoidance to be prevented. The second issue addressed by the court was effectively whether the Danish tax authorities could rely on the same EU law anti-abuse rule which was covered in its decision on the Parent-Subsidiary Directive joined cases. Not surprisingly, the court gave the same analysis as there, almost word for word. And the third issue addressed by the court relates to the situation where the Interest and Royalties Directive does not apply for reasons other than fraud or abuse. For example, the required level of association between the payer and recipient companies is not satisfied. In that context, the third issue was this: would Denmark's imposition of interest withholding tax on the interest paid to the Luxembourg or Swedish companies be invalid because it would breach the free movement of capital guaranteed by Article 63 of the Treaty on the Functioning of the European Union? The court answered this question yes, for two reasons. The first reason is that under Danish tax law, there's a significant cash flow difference between, firstly, interest paid by a resident company to a non-resident company, and secondly, interest paid by a resident company to another resident company. In the first situation, withholding tax is imposed up front on payment of the interest. In the second situation, a resident company recipient is not required to make an advance payment of corporation tax during its first 2 tax years. And the second reason relates to gross versus net taxation. With withholding tax, the non-resident recipient company cannot deduct interest payments which directly relate to the relevant loan, whereas in the case of a resident recipient company, it is entitled to deduct such interest payments. In case you're wondering whether the tax authorities or the taxpayers won, you'll have to wait until the referring Danish court applies the ECJ's principles to the actual facts of each case. In the meantime, if you'd like to obtain a copy of these 2 decisions, please go to our website. The European General Court has annulled a state aid decision made by the European Commission in regard to 4 Spanish football clubs. Those 4 clubs, Barcelona, Real Madrid, Athletic Bilbao and Osasuna, are all conducted as non-profit organisations. In contrast, all other Spanish professional football clubs are conducted as profit-seeking public limited companies. A non-profit organisation is subject to a preferential income tax rate. The Commission had decided in 2016 that that preferential rate constituted illegal state aid. However, the EGC has now annulled that decision because the Commission failed to properly take into account all issues and facts to determine whether or not the 4 clubs were provided with an advantage. For a copy of the court's press release on these cases, please go to our website. In Italy, there's been another indication that the recent Supreme Court decision on the Parent Subsidiary Directive is probably just wrong. I told you about that decision in ITB on the 15th of February. The new indication is a redacted private ruling issued by the Italian tax authorities. The ruling concerns the EU-Switzerland agreement, which requires a dividend withholding tax exemption in the same circumstances as the EU Parent Subsidiary Directive. The relevant Swiss parent company proved that it was fully taxable under Swiss tax law. That being the case, the fact that it was exempt from Swiss tax on the dividend income under a participation exemption did not prevent it from qualifying for the dividend withholding tax exemption in Italy. And now to Lithuania, which has been given approval by the EU Council to introduce a VAT reverse charge mechanism in regard to hard drives in order to combat tax fraud. The approval is effective from the 1st of March 2019, today, to the 28th of February 2022. For a copy of the Council implementing decision, please go to our website. And Luxembourg and Sweden have become the latest EU countries to announce a reduction in their VAT rates for electronic books. In Sweden, the rate will drop from 25% to 6% on the 1st of July 2019. And in Luxembourg, the rate will drop from 17% to 3%, but no effective date has yet been announced. In Angola, Parliament has enacted the new VAT law, which will take effect for large companies on the 1st of July 2019 and will replace the existing consumption tax. The standard VAT rate will be 14%. The new VAT is described as a slim VAT, which is said to be appropriate for developing African countries. In Benin, a government official has stated that the government intends to reduce dividend withholding tax rates for dividends paid by unlisted companies from the existing 10% to 5%, and for dividends paid by listed companies from the existing 7% to 5%. However, commentators have pointed out that the dividend withholding tax rate for dividends paid by unlisted companies is required to be between 10% and 15% under the rules of the West African Economic and Monetary Union. So something's going to have to give. And in Tunisia, the tax authorities have issued guidance on the 4-year income tax exemption for newly formed enterprises. This exemption was recently extended to enterprises which are formed in 2020. For a copy of the guidance, please go to our website. In Brazil, it's been reported that the tax authorities have started to enforce the tax on financial operations on delayed remittances to Brazil of export revenue, which apparently is a major change of policy. There's an exemption for export revenue. However, according to the tax authorities, if there is a delay in remittance, and accordingly the revenue has been invested for a period of time in a foreign bank account, it loses its character as export revenue. We'll see how this develops. In Mexico, the tax authorities have issued guidance in regard to the issue of whether certain types of income should fall within the business profits article or alternatively, the other income article in Mexico's treaties. This is particularly important as the other income article in Mexico's treaties generally allows unlimited source country tax in regard to income arising in the source country, even in the absence of a PE. Based on a domestic law provision, Mexican tax inspectors in the past have taken a narrow view of the business profits article and thus a wide view of the other income article in regard to income such as service fees. However, the recent guidance states that the domestic law provision shall not be used for treaty purposes. And now for this week's treaty developments. And it's been a very slow week. All we've had is one protocol signed. I have 2 articles for you this week. The first article is called Restrictions on Interest Deductions and Tax Treaties. It's written by Brian Arnold and it's published in the IBFD's Bulletin for International Taxation. In the words of the author, this article examines the effect of the provisions of the OECD model and the UN model on domestic law restrictions regarding the deduction of interest, including the earnings stripping rules recently adopted by the European Union and the United States. The author identifies these examples of domestic law restrictions regarding interest deductions: debt equity characterization rules, thin cap rules, earnings stripping rules, such as in BEPS Action 4, the EU's ATAD 1, and the US's amended Section 163J. Transfer pricing rules, whether strictly cross-border or not. Restrictions on interest deductions by residents to earn exempt or preferentially taxed foreign-sourced income. And restrictions on the deduction of interest by non-residents, for example, in connection with a branch or PE. And for the treaty provisions which can have an impact on these domestic law restrictions, the author identifies these in the 2017 editions of the OECD and UN model treaties. Article 1.3, the new so-called saving clause, which permits a contracting state, subject to exceptions, to tax its residents without restriction by the treaty. As you know, this provision is not included in the BEPS minimum standards, and thus, so far, most treaties don't include this provision, either directly or via the MLI. Article 9.1, the arm's length principle. Article 7.1, the business profits article, which is applicable to non-residents. Article 24, the non-discrimination article. And Article 29.9, the principal purposes test. Now, you might be wondering how the PPT made the list. The author explains that it's because the PPT can restrict the application of other treaty provisions which would themselves restrict the domestic law restrictions. Yes, a restriction on a restriction on a restriction. The author describes it in this way. It is conceivable that Article 29.9 of the OECD model and the UN model could result in the restriction of the deduction of interest indirectly by denying the benefit of Article 7, Article 9, or Article 24 of a tax treaty. One of the particularly interesting comments made by the author concerns the potential impact on earnings stripping rules of the arm's length principle in Article 9.1. First of all, he makes this comment in regard to the relationship between thin capitalisation rules and Article 9.1. The OECD Thin Capitalisation Report of 1986 indicated that the basic question is whether Article 9.1 of the OECD model and the UN model is restrictive or illustrative, that is, permissive. Taking the restrictive view, Article 9.1 prevents a country from taxing its resident enterprises controlled by non-residents on more than their arm's length profits. Consequently, Article 9.1 would prevent a country from denying the deduction of interest under thin capitalisation rules if the result was to tax more than the arm's length profits of a resident corporation. This restrictive view of Article 9.1 is the position adopted in both the OECD and UN commentaries on Article 9. He then writes this in regard to earnings stripping rules and Article 9.1. If Article 9.1 of the OECD and UN models is regarded as restrictive, as is currently the position expressed in the OECD and UN commentaries on Article 9, the earnings stripping rules that apply to arm's length interest as well as related party interest would be contrary to Article 9.1 in the same way that thin capitalisation rules based on a fixed debt-to-equity ratio that disallow the deduction of arm's length interest are considered by those OECD and UN commentaries to be contrary to Article 9.1. The second article is called The Right to VAT Deduction and the ECJ, Towards Neutral and Efficient Taxation in the Single Market. It's written by Martin Varjou and it's published in the Intertax Journal. If you're a specialist on EU VAT, then this is a good article for you. It explains how the European Court of Justice, over many years, has tried to balance two principles which are sometimes conflicting. The first principle is the right of economic operators to deduct input VAT, which has been described as a fundamental component of the EU VAT system. And the second principle is to protect the VAT revenue base of member states against tax fraud, in particular tax fraud committed in a chain of supply, so-called carousel fraud or missing trader fraud. The balanced outcome achieved by the court is described by the author in this way. When the details of the ECJ decisions are considered, it appears that objective rights of taxpayers to deduct input VAT are interfered with only when there is objective evidence indicating that their exercise can be excluded on account of the conduct of the taxable person concerned. Well, that's the way it is this Friday, the 1st of March 2019. I'm Steve Towers. Have a great weekend.